Bank of America just told its clients something unusual, not buy this stock or sell that one. They told them to prepare for something they called a post-bubble roadmap. That phrase only gets used for one kind of moment, the kind that happened in 1929, and the kind that happened in the year 2000. Here's what triggered it. On a single day in late May this year, 20 stocks in the entire S&P 500 closed at brand new record highs. Bank of America's chief strategist checked something almost nobody else thought to check. How many stocks hit record highs on the exact day the dot-com bubble peaked, back in March 2000? The number was also 20. Stay with me, because the strangest part of this story isn't the coincidence. It's what happened to the people who noticed it back then, and ignored it anyway. Here's the belief almost everyone has about the stock market. If it's going up and everyone's making money, I should be making money too. That feels logical. It's the same instinct that makes you join a long line outside a restaurant you've never heard of. That many people can't be wrong, right? But markets don't work like restaurant lines. The more excited a crowd gets, the more dangerous the moment usually becomes. Prices aren't driven by how good a company actually is. They're driven by how good people believe it will become. And belief can separate from reality fast. In 1999, everyday Americans quit stable jobs to day trade internet stocks. A company called Pets.com spent millions on a single Super Bowl ad while losing money on every order it shipped. Investors didn't care. The stock kept climbing. Until one day, it didn't. But here's a question worth sitting with for a second. What if the mistake those investors made wasn't about the stocks at all? Because there's a specific psychological trick your brain plays on you in moments exactly like this one. It doesn't feel like greed. It doesn't feel like risk. It feels like common sense. It's called social proof, and it's the same wiring that makes you trust a restaurant with a line outside. In investing, it convinces smart, careful people to do the worst things they'll ever do with money, and it convinces them it was the safe choice. That exact wiring is active in the market again right now, and the number that proves it might be the most important number in this entire video. There's a measurement called the Shiller PE ratio. It compares stock prices to 10 years of company earnings adjusted for inflation to answer one question: are you overpaying? Historically, it averages around 17. Right now, in 2026, it's above 40. In 155 years of data, it has only been higher once. December 1999. Right before the crash that erased nearly 80% of the Nasdaq's value. Think of it like buying a small pizza shop that earns $10,000 a year in profit. Paying $200,000 for it, 20 times its yearly profit, is a normal price. Paying $400,000, 40 times its profit, means you'd need 40 years of that shop's current profits just to break even on what you paid. That's roughly where the US stock market sits today. But here's where people usually stop the story too early. And that's exactly the mistake, because plenty of serious investors think this comparison is lazy, and they have a real point. In 1999, most of the hottest stocks had barely any real earnings. Today, the companies driving this market, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, are wildly profitable. Corporate earnings actually grew nearly 29% in a recent quarter alone. AI is producing real productivity, not just hype decks. Some analysts, including teams at Goldman Sachs, think this market still has real room to climb, precisely because the profits are catching up to the prices. That's a legitimate case. It's why nobody serious is saying sell everything tomorrow. So if the earnings are real, why did Bank of America's own strategist reach for a warning this blunt? Because valuation was never the whole story in 2000 either. The real danger sign wasn't just that prices were high, it was how few companies were holding the entire market up. Right now, 7 companies, the so-called Magnificent Seven, make up roughly a third of the entire S&P 500's value. Add just 3 more names, and the top 10 stocks control close to 40% of the index. If you own a typical S&P 500 fund thinking you're spread across 500 companies, you are, in practice, making a concentrated bet on a small cluster of names tied to one theme. Artificial intelligence. Ask yourself honestly right now, if you own an S&P 500 index fund, how many companies did you think were actually driving your returns? 500? Evenly? Or did some part of you already suspect it was a lot fewer than that? Here's the moment that should genuinely unsettle you. On May 29th this year, 20 stocks in the S&P 500 closed at record highs. Bank of America's chief investment strategist, Michael Hartnett, the same person who actually coined the term Magnificent Seven, pulled up the history books to check something. How many stocks hit brand new record highs on the exact day the dot-com bubble reached its peak in March 2000? Also 20. Not similar, not close. The same number, 26 years apart, both times right as a historic bubble strained at its seams. That's the kind of coincidence that doesn't prove the future, but it's the kind that should make you stop scrolling. Here's the coffee break line worth remembering. History doesn't usually destroy investors by surprising them. It destroys them by convincing them nothing can go wrong. That's what recency bias does. If something has gone up for 3 years straight, your brain quietly assumes it will keep going up. It's the same instinct that convinced people to buy crypto at its peak in 2021, or a house in 2022 at any price, because this time is different always feels true right before it isn't. But here's the part almost nobody talks about, and it's scarier than a crash in some ways. Historically, when this valuation number gets this high, the next 10 years of returns are often not a crash at all. They're just disappointing. Flat, sideways. Years of going nowhere while everyone waits for profits to catch up to price. A crash is loud and visible. A lost decade is quiet, and it can steal more retirement wealth than a crash ever could, precisely because nobody's watching for it. So what do you actually do with this? First, check what you own. If your entire portfolio is one S&P 500 fund, know that a third of it rides on 7 AI-linked names. Not automatically bad, but you should know it before a downturn teaches you the hard way. Second, consider spreading exposure. International stocks, smaller U.S. companies, or an equal-weighted S&P 500 fund that spreads money evenly across all 500 companies instead of stacking it on the biggest few. These often trade at far cheaper valuations right now. Third, and this is the real lesson, stop making decisions based on what the market did last year. A great run tells you almost nothing about what happens next. If anything, history says get more careful, not more confident. Exactly when everyone around you is celebrating, and keep contributing steadily, high prices or low. It's the least exciting habit in finance, and it's built more American wealth over 50 years than any prediction ever has. Robert Shiller, the economist who created that valuation ratio, has said it plainly. This number doesn't tell you when a crash happens, only that the odds have shifted. Markets stayed too expensive for years in the past before anything happened. Some investors who panicked and pulled out in 2020 missed years of gains that followed. Caution and panic are not the same thing, and confusing them is its own expensive mistake. So here's the question I actually want to leave you with, and it doesn't have a clean answer. We usually assume the biggest risk in the market is another crash like 2008, sudden, brutal, over in weeks. But what if the bigger risk for most people watching this right now isn't a crash at all? What if it's spending the next 10 years fully invested in a market that goes basically nowhere, while you quietly assume everything's fine because nothing crashed? If you knew the market was this historically expensive, would you keep investing the same amount every single month, or would you sit in cash and wait? There's no obviously right answer. That's exactly why it's worth sitting with. Subscribe if you want more videos that break down money and psychology in plain, honest language. And tell me in the comments, cash on the sidelines or steady as it goes. I actually want to see where people land on this one.